Hello, everyone. My name is Armando Perez-Carreno, and welcome to the Web Talk Show. Today with us is Stephen Pivnik from AIP Advisory. How are you, Stephen?
I'm great, Armando. Thank you for having me on the show.
It's a pleasure to have you, Stephen. I am very interested to hear about everything you do in this space, and I want people to understand what we're going to be talking about today. So, can you tell us a little bit of what you do right now and how you got to this point?
Sure. I currently am paying it forward in the entrepreneurial community by advising founders of middle market companies on how to strategically plan for and execute an exit for their company. And it's really rewarding being on this side of the transaction after going through, several transactions of my own. I got here by starting, growing, scaling, and later selling a technology company. I grew to over 200 employees across 12 countries. We service like 90% of the global 5,000 customer base. And after 26 years in business, which was a little bit too long, I finally realized a strategic exit. And shortly thereafter, like I just mentioned, I got into advisory work, and I'm really enjoying living vicariously through other founders and helping them go through a similar journey.
That's incredible. I hear this a lot, not specifically, you have an amazing background, but I hear from people that have done well who then like to help others in that same path. And I love that because it brings so much back to why we are humans and why we're different from machines, of course, but then also
Exactly.
in this era, but also the rest of the animals and everything in the world. Like, we not only strive to do better, but then also to help others, and that is something incredible, and I admire people that are doing that. What do you think that people should consider when they're doing so well? Like in your case, you were doing very well. You had scaled. You were there for 26 years. And the way you said it, that maybe too long. What's the point in time when a founder or owner should start thinking, like, does it make sense to look for an exit? Is it something that everyone should do? Is it something that it's only for some people? Is it a legacy thing? Like, when should one start having these thoughts or these conversations with oneself, whether it makes sense, or start even talking to someone about?
Yeah, I mean that's a great question, and the short answer is it's different for everybody. But I'll give you some of the things that I feel everybody should be considering. Right, the right time is going to be different for most. If I had to pick a point in time, I'd say between the 10 and 15-year time frame, because at that level of a company, you've probably established some serious enterprise value, and you've worked really, really hard at it. Yourself and your other co-founders have probably put in a lot of blood, sweat, and tears. And you should really explore opportunities to see if you can finally monetize what you've created. At least get a benchmark for what you could potentially achieve in the marketplace via a strategic exit, or even possibly an investor recapitalization if you want to maybe take a little bit off the table and continue to go after the proverbial, second bite of the apple in the future. So it should definitely be investigated. And there's a lot of reasons for it, right? It's because a lot of founders have the majority of their wealth tied up in their company. 90 to sometimes 100% of people's wealth is tied up in their company. That was the case in me, for me, my company. And that's a lot of risk, right? Even though the company is doing well, you can paint a really decent story and trajectory into the future. But there's no guarantees in life, right? And maybe the next COVID is around the corner, and it'll impact your company like it impacted so many, right? So there's just a lot of risk in continuing to have 100% of your net worth tied up in one illiquid asset. So again, 10 to the 15-year mark is when I believe it should be investigated, and then if all the stars align, exit should be pursued, and if not, continue for another, 2, 3, 4, 5, maybe 10 years. It all depends on a lot of factors.
Well, that's great advice, and I like the terminology here that I think most of us haven't heard. So that's what's the second bite of the apple?
Right. So the second bite of the apple is if you find an investor that wants to, let's say, invest and take over 51% of your company, or pick up, investors are different. Some will go in for a minority, let's say 10 to 20%. Other investors will want 60 or 70% of your company. That leaves you with additional equity that you roll forward into the venture that continues with the private equity partner, right? The private equity partner is almost always, not almost, will always sell the company again in the future. And when they do, you get your second payday, or as they call it in investment banking terms, the second bite of the apple.
I see. Oh, this is very interesting.
And
We were,
often,
yeah, go ahead.
just to add really, really quick, there's a lot of scenarios where the second bite of the apple, in terms of the financial check, is greater than the first. So you can get a really decent size return. Uh, Let me do that again. You can get a really decent sized amount during the first round, and when the company continues to grow and is sold again, that second part, while it represented a smaller percentage, can actually be bigger than the first part. That happens all the time.
Yes, that makes a lot of sense because if you brought people into it, you likely brought them because they're bringing along experience, they're bringing along network, they're bringing along spending power, technology, right? And so that will very likely make the company grow, regardless of it was already growing. And so
Exactly.
even if percentage is smaller, you might get a bigger gain. That's a lot to think about. There's there was this conversation we were having with Matt Middendorp about like the different options to private equity or going into ESOP or things like that, right? So it's like there's options and there's positives and negatives in all of them, of course. But what I've heard a lot from not too many people, but from people who have done exits, sometimes these transactions don't go as one would expect. Like going into it sounds amazing. Oh, I'm gonna get some money from I'm gonna get capital, right? And they're gonna invest. And when you see this big number, and then once you get closer, it's like now it's this, and now it's this, and now it's this, and it's still a big number, but you started with this idea, and then it comes down, and then there's strings attached, and then there's a bunch of other factors that you have to stay in there and you have to do it. And so it sounds like a great dream, but for many, it's just a dream. And then by the time they get to the end, they're so tired of the whole process, they just want to get it over with. And then they're burnt out at the end. We just recently spoke with someone and they did an exit and it was like a home services company doing great and all that. But then like you see them and they look like gray. You know what I mean? Like it's like, and
I,
so
I, I I totally know what you mean.
yeah,
Yeah, I mean, and unfortunately, this is definitely on par for the course. It happens a lot. If the proper planning wasn't done significantly way in advance, if there's a last minute opportunity that somebody takes advantage of, and then you're definitely going to be at the mercy of the person that's doing the deal, right? There's a lot of deals that get the term for it is repriced. They get repriced along the way. Terms and conditions change. Their requirement for you to work or not work changes. It could go from a lot to a little, or vice versa, depending on what they find in due diligence. So all of this stress can be avoided, or most of it, I should say, is if the proper planning is put in place and you architect a proper deal that you personally want. For example, in my case, I wanted to make a 100% sure that I was not part of the deal. And the way I did that was I brought in a CEO, 3 years prior to the actual exit, so that when the exit came, when we went into due diligence, it was 100% clear that I was no longer an integral part to the day-to-day operations of the business. Now, other people may never want to leave their baby, right? Because they're emotionally attached to their company. their personal identity is wrapped up in their company, and they definitely want to stay. Well, in that case, a deal can be orchestrated from the very, very get-go, and those terms and conditions can be laid out even before you go into due diligence. And if you're brave enough, you can tell the acquirer or the investor saying, these following 5 terms, they're non-negotiable. If at any point in your due diligence you discover something which makes you uncomfortable with these 5 terms, whether it's the amount, my involvement, my employment, my employee's involvement, et cetera, please walk away from this deal. And most will be very, very upfront. Like I actually had one deal prior to the one that actually closed, where we told them at the very beginning, do not reprice this. If you come back with an adjustment to the enterprise value that's on the term sheet, walk away. And after we went into due diligence, in 3 weeks, they said, you know what? You asked us to walk away. If we couldn't commit to that number, we're walking away. Fine. And guess what? They came back 3 years later and paid 50% more.
Yes. Yeah. Wow. That's a great example. You have to stand your ground, right? So if you have the right data and if you're not taking advantage of anyone, if you believe in something, I think that's what people say, right? So if you really believe in something, then stand your ground and you'll get more out of it for both sides. Like in that scenario, don't just do it because you're arrogant, right? No, if you have the data to back it up, then yeah, because there are things that are non-negotiable, and that's a great idea to put them up front. Don't be scared about it,
Sure.
and say these are the things. Now,
Right.
what I really liked, Myron, what's his name? Myron Golden, or sorry if I missed the name, but he recently said something about why he never got emotionally attached to a deal since the very beginning, because he started from the bottom, right? And he was saying, because he learned about the percentages. And so he said, if you go into a negotiation in business, just regular transactions, if you get tied up in that deal and you think you have to close that deal, then you're on the lower hand, right? Yep. And then you're gonna be on the losing side. If you don't think of it that way, if you let's say you're doing very well, then typically you don't have that. You feel confident and you close more deals when you're doing well. So it's like, but how they were asking, like, how do you not feel that way? And so he talked about averages. He said, well, because I know I don't have to close that deal. I know that I need to close a deal. So if I'm doing X amount of conversations, then that means that I'm going to close a certain percentage of them. So I just go into all of them the same way, because it doesn't matter if that one doesn't work. I do need the money, but I don't need that money, right? So changing that framing is just a little thing. So I think it applies to many things, like you're saying now, which is incredible.
Trying to be emotionally detached from outcomes is incredibly important. I mean, that's important with a conversation with your kids. It's important with a conversation with your spouse. It's definitely important in negotiating either sales for your company or the sale of your company, because when emotions get involved, then like you said earlier, all of a sudden you start losing a little bit of leverage to potentially a lot of leverage, and you're not going to get the best deal possible.
We talk about some of the concepts and different phrasing that many people will understand, but then there's some listeners that are not in the business space and have never been. So can you help us understand a little bit more about the terminology? Like when you say middle market, what type of companies, what type of size are we talking about?
Everybody has a slightly different definition. If you Google it, you'll probably get a slightly different number. I consider middle market anywhere from like $20 million to $500 million in annual revenue.
Okay. And does that change with headcount, or is it mostly revenue based?
It's mostly revenue based, and you'll have that same type of revenue being accomplished by different amounts of headcount depending on the industry, right? If you're a software company, it'll be smaller. If you're manufacturing actually hard goods, it's probably going to be larger. So headcount is always going to differ, but middle market typically refers to revenue.
Okay, excellent. And now, if we talk enterprise value for a company, again, many people know about revenue, they know about profits, right? But what does enterprise value mean for a company?
Sure. And so enterprise value is what your company is worth to an or what your company is worth to an acquirer, right? And that the value gets calculated different ways, again, depending on industry and depending on size. And it's what's the majority of the calculations are one of two things. It's a multiple of revenue. So for instance, if you're a SaaS company, software as a service, you can, if your company is, let's say, doing for round numbers $10 million a year in annual revenue, your enterprise value is probably going to be anywhere between 40 million and 70 million dollars, 4 to 7 times. Sometimes if you're in a really, really hot space, like anything AI related, it could be, 10 or 20 times on revenue. Most other businesses are evaluated, based on their profitability or EBITDA. And those multiples range from anywhere, 4 to 12 times what your annual profitability is. So that can equate to your enterprise value.
Oh, interesting. And is that why then some people say, well, yes, you could invest in something like real estate, but then you could also invest in companies because they can produce, right? And then the valuations are not like, oh, that company's not worth $3 million because it makes $3 million. It's actually worth a lot more.
Exactly. So it's typically worth more because companies are typically priced on future earning potential. And again, deal structures always vary. That value can be paid to the seller upfront, or it can be paid to the seller in the future based on future performance, which is very common. And I highly suggest against it because there's a way to actually get all your money upfront. But if you go down that route, it's typically called an earnout. And the earnout would say, let's say the seller wants $70 million for the company, and the buyer only wants to pay 50. You could come to terms saying, okay, the seller gets 50 million today, but you can get an extra 20 million over the next 3 years based on performance. And then there's a whole bunch of measures that are put in place to measure that. And sometimes it works out, sometimes it doesn't. A lot of times it's in the middle. There's a whole bunch of factors that come into play.
Well, I bet, especially with what you said, like in your case, if you don't want to be a part of the company necessarily because you're moving, you're doing your second business venture, whatever. If you do the earnout route, it's likely that you're gonna be pulled back in to make sure that the performance is met. Otherwise, you're not gonna get your. So it's not
Yeah,
required, but
100%.
it's
Yeah.
it's it's like very likely. that-
And in the vast majority of the cases, the owner will stay on for the duration of the earnout. And if there's an earnout component in somebody's deal that somebody may be listening or watching, it's really, really important to maintain control over the elements that will dictate the earnout, right? The sales force, the marketing efforts, and the accounting procedures that are being used. Because if you get swallowed up into a much larger organization, and let's say you lose control over the sales force or you lose control over marketing efforts, and you're part of the company, which is now a division of a bigger company, isn't getting the love that it used to be getting, then your performance isn't going to be the same, and your earnout will suffer, and that's going to cause some serious friction between you and the acquirer.
That is very logical. I've Many of the deals that I've heard about, they go in, it's a bigger entity, and so they already have their finance department, they already have their marketing, and that's why I was going to ask, like, why do they let go so many people many times after acquisitions? Probably because they already have a component of that in the
Yeah, I mean
structure.
every single deal is different, right? And in a lot of organizations, they will completely cut out any
Mm-hmm.
duplication.
Mm-hmm.
And in other deals, they're going to leave some, if not all, depending on how unique the acquired company is to the bigger organization.
Mm-hmm. Yeah, but the problem is in many of those cases, like that marketing effort or that finance department, that was what made that company grow the way it was growing. So what you say makes perfect sense. It might decline right after the acquisition because they let go everyone who was actually holding it up.
Exactly. Exactly. So again, these things need to be carefully thought out, planned, and architected in a way to maximize the results for everybody involved.
When you have a company that's doing well, but you are the head of the company very publicly, you're the brand. In your case, you sort of stepped out earlier, maybe 3 years before, right? That's a good idea. But let's say someone's like really in it. That's like a Mr. Beast, right? Like Mr. Beast is Mr. Beast, right?
He is his company, correct?
Right. So, is there any way to get to do a shift, right, of something like that, or when it's completely personal brand based, does that just not happen?
It's really risky, and there's a lot of things that are valuation killers, and valuation meaning enterprise value, right? Let's say the industry is saying that this company should be worth 5 times revenue, for as an example. If the acquirer finds out that there's a very high dependency on the founder, that valuation is going to get discounted because that represents risk. Because obviously the acquirer is going to want to make sure that the individual, comes along, but there's no guarantee that the person's going to stay. They may leave for a variety of reasons in the future. It could be health related, it could be a new opportunity, it could be boredom, it could be a million things, right? So founder dependency represents risk and is a valuation killer. So my advice to anybody is to slowly but surely, you can still be very much involved in your business, but make sure that the company can run without you. Best way to prove that is go on vacation for 3 months. Take a 3 month sabbatical. See what happens with your company. If it's in the same shape or better, you've done a great job of eliminating founder dependency. If you come back to a mess, you got work to do.
That's a great idea. And in some cases, for the content side, especially 2026, it's all about the content. And we had a conversation on the show a few months ago where we were talking about like building a brand and the brand persona and all that. And in some instances, the founder or the owner is the main head, but it doesn't have to be, right? So we hear about doing content, and every company should do content. But what an expert that came on was talking to us about is, well, it doesn't necessarily have to be that person. It could be multiple people in the organization. So it could be the people who are in the trenches, who are actually doing the things, doing the work, that they could have a few different faces that are showing up and doing all the content, such that, again, it's not completely dependent on. So the company still creates content and still creates rapport with people in this age, but it's not solely like owner focused.
I would actually argue that actually raises the perception of the brand, right? Because if there's only one face to the brand, then again, there's this perception of dependency on that face. Versus if there's multiple faces to that brand, then it's more diversified and therefore less risky to whomever is looking to acquire them.
Would you say that somebody who is in the scenario of having a company that's very valuable or could be very valuable, but they are the person and they want to raise capital, but it's going to be too risky or it's going to be heavily discounted for VCs or private equity, could they go the crowdfunded route? Could that make sense? Because then the crowd is also maybe a fan of the person. They could do the capital raise and at the same time like reduce that. What do you say?
Founder dependency is a little bit less negative from a capital raise perspective, because when somebody is making an investment in the company, they're betting on not just the founder, they're betting on the team. So it's really important that the investor have a lot of faith that the founder and the team is going to be a great steward, for their money and for their investment. So it's a little bit less risky for them because that's actually who they're betting on. Yes, they love the product, they love the company, they love the profitability, but they're betting on the team. So from that perspective, it's really important to show how great the team is. Crowdfunding is, definitely an option for any sort of raise. And they're going to, obviously, crowdfunding does a lot less due diligence, and a lot of the details of the company are going to be, less available to a crowd. But I would be less concerned about founder dependency from a capital raise perspective, and more concerned from an exit perspective.
Yes, that makes perfect sense. When people exit companies, in your experience, because you help people with this whole process, is it something where maybe they do one business, they do really well, they have an exit? Do they typically relatively soon after just create another venture and then do it all over again and then do that, or do they just stop? Like, what is there, or is it not? There's no percentage really.
Yeah, yeah. I mean, I've seen it all. I've seen people, serial entrepreneurs. They go from, one to the next. They just being an owner of a company is what defines them. Running a company is what defines them, and what they love to wake up every single morning doing. So they sell one, they go start the other. They're success. Now that they have a playbook for building and selling a company, they do it again. And I'm not going to say it becomes easier, but the process is better known to them. There's others that just, completely retire. I personally, I had a whole bunch of endurance sports hobbies. So I kept myself very busy doing triathlons, Ironman, and mountain climbing before I started taking up more hours doing advisory work. And there's others that, take on board seats this way, or advisory roles, like myself, because this way they can participate in the growth and give a lot of advice and suggestions on the growth of a company without having to be involved, 40 to 60 hours a week. And they can spread their knowledge across multiple organizations, which is very rewarding to some. So the best part about an exit is it gives you a lot of optionality, right? And you get to decide what you're going to do next when that deal closes.
Yes, that's a good point. If someone has done an exit recently and they're wondering what to do with their time, yeah, advisory is a great way to go. Boards, that's
Yeah,
also.
there's a lot of people. If you've had a successful exit, there's a lot of people that are in your shoes, or that are in the shoes that you were in a couple of months ago or a couple of years ago, that would love to pick your brain and get your advice. And that can come as a kind of loosely formed advisory type role, or it could be a much more official board role where you actually have a stake in the company and fiduciary responsibility to perform in its best interest. And there's also philanthropy work. I've seen a lot of people just go into philanthropy. They made so much money that they decide that, what, I'm going to give away most of it, but I want to be in control of where it goes. And, Bill Gates, perfect example. He's spending the majority of his time giving away his billions.
Well, you get to a point that it's so much money that you can't spend it all, but you can use it in good ways. And I think that control part is important too, because sometimes you donate things, you don't know what they're doing with it, etc. If you're at a place where you can actually have a foundation or have the supporting structure to make sure that those funds are executed properly, then
Exactly.
that's amazing. So when you talk to companies, you're advising companies there, they might be close to that area where they might be considering an exit.
Hmm.
Do you see the same patterns? Like, is it something that most people just hit the same sort of walls time and time again?
Yes, and I love the term pattern recognition, because after doing it for my own company for 26 years, and after advising a lot of other companies, there's a lot of patterns that develop. The biggest challenges is really around team, and having the proper executive leadership team in place in order for the company to continue to succeed. I say this all the time. All founders, myself included, are incredibly loyal to their staff, especially to the folks that have been with them from the very beginning. And as a company grows, it's almost inevitable for a company to outgrow the person's capabilities and skill set, just because it's not a knock on the individual. They've just never operated at a certain level. I like to pick on sales because it's the easiest to quantify. If your head of sales was with you from day one, and your company, let's say, has gotten to $10 million, he or she has never run a $10 million sales organization. They don't have a playbook on how to take a $10 million company and bring it up to a $20 million company. They're gonna figure it out, as they go along. And some of them can, and some of them will, but many of them won't, and they're going to suffer. So that's a telltale sign that you need some professional sales leadership. And everything I just said can be applied to your head of product, to your head of finance, to your head of marketing, to your head of support. The list goes on and on and on. And just looking at the team, and this is the interesting part. When you're done looking at your team and you've potentially made some upgrades and moved some chess pieces around, then it's time to look in the mirror and say, are you the right person to continue running this company? Or is the company better suited to have a professional, CEO in place? Which is exactly what I did. I did it for two reasons. I did it because I wanted to make sure I wasn't going to be part of the exit, and I also wanted to make sure in case there wasn't an exit, I wanted to put my company in the hands of a professional CEO for day-to-day operations, so that I can do other things and the company would be in great shape.
Yes. Yes. I don't think most of us realize until we're in that position the severity of what you just said. It can sound from far like one can be arrogant and say, they're saying they need like the big league players, right? And one of our guests was giving that analogy of like he played hockey before, so he was like, yeah, he works in family office and all this, and he was explaining how, yeah, maybe you have the person who helped you in the bank at the beginning and they're very good and all that, but once you're at 20 million, that it's a whole other ball game, and so you probably need to bring in a different type of professional level. The same way he gave the example of like I could have had a magnificent hockey coach or football coach in high school, but then if I go pro, I'm not gonna use the same coach, even if they're great. Like there's different levels, and same goes for what you just said, like sales. Maybe you run an e-com and you're doing great. You're selling 100,000 units a month and you're amazing, right? And your staff has done it. But then you grow and that person is not going to be as practiced as someone who's selling 100,000 units a day, right? So if you bring someone in that has done that before, then they understand the scale and all the complexities that come along logistics wise and everything. Yep. With that.
Yeah, exactly. This is, I'm not going to say the downside because growth is a wonderful thing, but this is just one of the challenges and sometimes stresses that come with growth in a company. That so it helps to understand this from the very, very beginning, knowing that the people you have around you may not be the same people 5 years from now when the company continues to grow. In some cases, they will be, and God bless, and that's a fantastic scenario. In some cases, they won't be.
What do you think about the concept of coaching as you're growing, both for yourself as an owner, CEO, as well as for key people in your business?
Yeah, I'm a huge fan of it, and I don't mean this to sound self-serving. I'll talk about it like when I was it took me too long to bring in a coach and an advisor because I was young and arrogant, and the company was successful and it was growing. I'm like I'm doing great. The company's doing great. I don't need any help. Well, when I finally got some help, we were doing even better and everything was even smoother and things started going that much better. I mean, it applies to like the sports analogy is perfect. If you're a naturally gifted individual and you're a great hockey player, you'll become a phenomenal hockey player, with the right coaching. So that applies to leadership. I'm sorry, to ownership of the company, and definitely to various people on the leadership team. For instance, like I had a head of sales, and I hired a coach to help him, and he was incredibly appreciative because some people think if I get this person a coach, they may think that I'm not happy with their performance. It was the other way around. My head of sales was so appreciative. He's like, "Wow, you're making this investment in me and my career. thank you. And he was super appreciative for it. And we benefited because the sales performance improved. So very long answer. Huge fan of coaching across the board.
Yeah, well, I hear it again and again. There's many guests that have come on the show where we bring this topic up because there's two sides. There's people who see coaching as like a handicap. They're like, oh no, I don't want to be seen like if you were going to therapy or something. Like, no, no, no. Well, first of all, therapy is good, but if you need it, you need it. It's good. But
Yes.
coaching, like, it's not that you're not doing good. It's not that you're not good. It's that that person has already overcome a lot of the barriers that you're about to face, and you can just skip over them. Like
Yeah.
it's like going on the street and there's a boulder in the road, and then there's this guy with a crane that could just lift that boulder away, and you can keep going. So yeah, I'm a big fan too, and I think unfortunately there are a lot of scams and people who sell coaching who haven't been in it. We at the very beginning of our call before we were recording, we were talking about like how sometimes numbers are thrown out and people are talking about an industry, but they've never played at a certain scale, right? And it's not
Yeah.
helpful for
I
their
know.
clients, right?
I know exactly what you're talking about. I met somebody. I was at a networking event yesterday in Princeton, New Jersey, and somebody came up to me and they said, "Hey, Stephen, I was told that I really need to meet you. We should compare notes." I said, "Sure, great to meet you." And he's like, "Yeah, I do executive level coaching," and he started talking about what he does. He's like, "I'm certified in this. I'm certified in that." And so I asked him, so have you ever run a company? He's like, no, no, no. But I took this class. I have this MBA. So it's great. I'm not knocking him, and I'm sure he's giving phenomenal advice. But what he's missing is the actual experience of being on the ground and being in the person that he's coaching shoes, and having to fire your best friend, staying up all weekend because you can't make payroll, dealing with a customer satisfaction issue of your number one customer, which represents 40% of your revenue. They've never been at that type of stress level, and they can only give textbook advice. So to avoid the scams that you mentioned, which are definitely out there, make sure that the person has actually been in the shoes of the individual that they're coaching, because then the chances of success are going to go up.
That's that's very good advice. That's a great way to look at it. Like, have they played that game before? Sometimes there's a tricky part here. Sometimes someone might look new, so giving the other route, right? Someone might look like, oh, they just got started. But if you peel off the layers, oh, but they worked at these three giant companies and worked on all these deals, and they were the number one in all these deals. And now they're spun off and doing their own thing. Oh, okay, so they're new, but they've done this before, right?
Exactly.
And then there's those on the other side who will say they worked on the deals, but they were doing paperwork or something, working in said company, and then attribute some of those numbers to make it
Yeah.
look good. So you just have to be careful of that. But that aside, yeah, for sure, coaching, getting advice from people like yourself who have done these things and have seen the issues, because there's when you run a business, it's and it's different for all businesses. Like if you run a food services business, like all the things that can happen. If
Yeah.
if you run like CPG, there's a whole thing. If you're doing manufacturing, it's a whole other level of different. Like they're all very different, and being able to provide that advice or get that advice and accept that advice is helpful for both sides.
Yeah,
I
and
like,
that's the hardest part right there,
yeah.
is actually taking the advice and doing something with it,
Hmm.
because it's otherwise, like when I first started coaching, it was very, very frustrating when I would have meetings with folks and they appreciated everything I had to say. They took copious notes and they said, "Great idea, great idea, great idea." I'd come back a month later. Let's go through the list that we mutually agreed on last time we met. What'd you get done? He goes, "Oh, I don't have time for that. I don't have money for that." Like, Why'd you agree to do any of it? And when this same exact response happens, 3 months in a row, that's not a very fruitful relationship for either side.
Yeah. Do you think some people are coachable and some people are not coachable?
100%. You got to figure out who's and just because somebody says they're coachable doesn't mean ask them to give you examples, right? To give me an example where you were doing something and somebody told you to do it differently, and you actually took that advice. And if they have a hard time with that, then they're probably not coachable.
And it's funny because somebody might not be coachable now and then hit an important situation and it clicks and now they're coachable, right? So
No,
it's like,
100%. Or
it could change.
maybe they were never in a position where they actually really got good advice from somebody who was more experienced than them. And when they finally came across that individual, they're like, maybe I do want to take this person's advice.
Yeah. Yes. I really look up to the older generation who has come before us, who is still here, who have done everything and gone through, like pattern recognition you were talking about, that have gone through all these loops many times throughout their years, right? Because everything sort of repeats. And then they leave the workforce and
Hmm.
they're doing nothing. And many of them, a big percentage of them. And I always think like there's so much value that we can get from both sides, for them to maintain themselves active, and for us to learn from them, because they already went through 60 years, 70 years of examples of all the unique situations that can happen in a business environment, whether they were in an executive role or were the owners.
Hmm.
There's so much that can be gained from just talking to people, because you can tell them what's going on right now and they're like, oh yeah, that happened to me 40 years ago, we just did this thing, and you're like, oh come on. Like you've been spending a week thinking about what what you could do, and for them it's
Absolutely.
nothing. So I wish there was some sort of way to get that sort of back and forth going with this huge concentration of knowledge that we have, because like in your case, you have so much experience and you started doing advisory very early on, right? Like at a young age you're doing this, where like imagine all those people who are retired, really retired, not like I retired at 30, but and then how much value we could get out of that. What are your thoughts on
Yeah.
that?
No, I couldn't agree more. It's interesting. Something came up on my social media today, and it said you have to immediately go out and become good friends with 10 rich people or richer people than you. And just to so you can be in those circles and hear what they talk about and get advice from them. So very similar to what you're saying. Like I think a stroll, you have to go where these people hang out. I mean, these people typically hang out, I would say, in country clubs or in resorts.
So I was gonna say like golf, yeah.
And they love to share. There's very few of them, I think. If somebody came up to me and just said, "Hey, can I ask you a business question?" There's a 100% chance, and unless I was rushing to someplace, I would listen to it and I would give them advice. So people, to a very, very earlier point, we are the only species that likes to help others. And I love this saying: a candle doesn't lose its flame by lighting another, right? So you can still remain at what level you're at, and just light somebody else's flame, and let them grow as well. It doesn't hurt you. It doesn't take anything away from you at all. So if you seek it, you'll find these individuals that can give advice.
Yeah. I have you seen the School of Hard Knocks? He did his videos, right? So if any
His
listeners,
videos are awesome.
they're really good. He's doing Man on the Street, right? So that's basically the concept of someone walking around the street being filmed and asking questions to random people. So he obviously now has a way to find the right individuals, of course, but he goes on the street and he finds millionaires, billionaires now, right? And he asks them questions, and he's like, "How did you get rich? And what can you tell people about overcoming whatever, right?" And he's really good at thinking of quick questions to ask them, and you can see what you're just explaining now, which is most of these people, except a very select few, are very happy to provide the advice. Of course, he comes indirectly, gives some report, like social proof, like, hey, I've talked to 43 billionaires in the past few weeks, right? Like, and so they're like, oh,
Yeah. I built a channel with 22 million followers.
yeah. And so he does that first, but then he talked. But at the beginning, he didn't have that, and he still did
Correct.
it, and he got
Yep.
to talk to a lot of people, and that's how he grew. But people are happy to provide that advice, even at that level, even if they're with their friends or whatever. Like as long as they're not like rushing to something, like you were saying, which
Yeah,
brings me to
exactly.
an interesting point that my wife and I talk about all the time. Really successful people, like really, really successful people, are not busy. Like they're busy, right? Because they keep their time busy, but they're
That's a great
not
point.
busy. Like you can stop them in the middle of the street. They can stop because the world will stop for them, right? It's like it's very different. You see people who are successful, and they're like, no, 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 I don't have time for this, blah, blah, blah. And you're like, if you were really successful and it interested even you a little bit, you were like, yeah, yeah, everything else can wait. It's fine. Like, unless you're like, I have a conference now that I'm going to give, then yeah. But other than that, you can typically call someone up and they'll be like, and Don Martell said, like, I can just call up any billionaire friend I have and they'll take my call, right? Because they can.
Yep. Oh, 100%. And short of waiting outside a country club and interviewing people that are coming out of Rolls Royces and Lamborghinis, you can just go to this wonderful tool we have called LinkedIn. Find somebody who's very, very successful, and pop them a message. And I think you'd be very, very pleasantly surprised with the responses. As long as you come across, sincere and
Mm-hmm.
honest without selling them anything,
Mm-hmm.
say, hey, congratulations on all your success. I'm in this sort of predicament in this type of business. Just wanted to get your 2 cents on this.
Yes. Yes. Oh, I can vouch for that one. When I was starting the show, one of our first guests, LinkedIn, I was talking to people on LinkedIn and things like that, and I connected with Colonel Joe Franklin, and he was telling me, it was very interesting. We did the connection, and he asks people like, hey, why did you send me a connection request? He starts a conversation, and so I talked back a little, and then he's an older gentleman, and he said, oh, let's chat. So we get on the phone, we talk for like 2 hours. We're just
Wow.
chatting, and he was telling me about like how like the parallels between corporations and the military, and a bunch of other stuff. And then he came on the show. Like that was just a chat, right?
Hmm.
And it was so refreshing to see that humanness of someone who, I mean, clearly is very successful, but also very highly positioned individual, and they gave so much time to just chat with a younger person about business, right?
Yeah, exactly.
And then we did the show, right? And so that that to me was amazing. And so LinkedIn, yes, it's a great tool. He was actually one of the first people to use, like he was telling me the story about how in the first days when he was actually using it to help people uh, sort of transition from the military to
Okay.
the corporate world, because
Got
there's
it.
so many parallels between what they do in managing like ships and fleets and things like that. But the language they use is so different. So when someone in
Hmm.
the corporation asks, hey, have you done this? They're like, well, no, because the language is completely different. But then he would help them explain, like, no, 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 just frame it this way. And it's just changing the wording. And they're like, oh my God, you have so much, like, you're overqualified for this role. Because you've had like 200 people under you, plus like supplies, plus maintenance, plus inventory. Like, so, and, and he was saying how in the early days, he would talk to like the main people at LinkedIn, and like something wasn't
Hmm.
working and they would go in and fix it. Like 'cause it was
Right,
way
right, right.
back, right? And it was very interesting. So yeah, definitely LinkedIn. But do you think people? This is a question I've asked myself. Do owners, founders, successful people, people who have exited, etc., use LinkedIn for real, or is it only like people in their companies that are using LinkedIn? Because I get this question asked all the time. Like, do actual decision makers use LinkedIn?
Um, I think they do. I mean, I think just the usage numbers alone, speak for themselves. It's an incredibly popular social media tool, and I think people across the board, whether they're actively involved in the businesses or just after the fact, because there's just so much great information there, and everybody, especially really smart people, are just naturally curious, right? So even a retired person, I think, will continue to be naturally curious about what's going on in the world. And obviously, they can read the Wall Street Journal, which they probably do, or any other newspaper. But it's just such a unique way to get to be kept up to date with things that are going on and different people's opinions and perspectives. And so I think the answer is yes. I think even folks that are retired, continue to utilize it just to continue to learn.
Ah, that's a very interesting use case. I hadn't thought of LinkedIn. Like I use it that way. I go in and I see because my feed now is a little interesting. Before it was all HR stuff and things like that. That's what you would see on LinkedIn. But now people do actual content. And so it makes sense that people can go there and the same way I consume my news or whatever I'm interested in the tech world
Hmm.
in X, right?
Yep.
Yeah, you could do the same on LinkedIn and it's a little more vetted, I think, in the sense that you see the trail, right? I think that's really the differentiator of LinkedIn that I can in 2 seconds see how you and I are connected
Hmm.
via other people and see, okay, is this person legitimate enough to be in certain circles or are they just making slop up
Right.
and I should have listened to them. So
Yeah. Yeah. Exactly. Exactly.
that's great. I think people should follow your advice and actually talk to people. There's no loss in it. It's I like to share, like even where I am, I like to share. There's always going to be someone who is in the position that you were before, and there's always going to be someone that is in the position where you're going to be. So yeah, so if someone comes up and has the same issues that I saw before, I'm happy to tell them. And then if someone tells me what I'm missing from where I want to go, then I want to listen to that too. It's
Yeah, on that topic, I saw another really interesting post today. Ryan Serhant,
yeah,
who's like
yeah.
one of the big realtors in New York and in many other big cities now. His post today was when something bad happens, I need to blow off some steam and I need to go chill. I just go for a walk around the block and I make sure to talk to one stranger. And today I just talked to a random person. He was from Texas. He had no interest in buying real estate in New York, but his cousin was doing some sort of development project in California that was potentially looking for some assistance with. And he put me in touch with him. And who knows what's going to come of it? Maybe nothing. But that's how that entire connection started, just by me saying hello to a random stranger on the street. So
Yes.
I
Yes.
got similar advice many years ago when my wife and I moved to Manhattan, and the advice was speak to one stranger a day. And I literally went to a bar. I was running errands, and I stopped in to get lunch, and I just struck up a conversation with the person next to me, and it was so interesting. I can't believe that I didn't continue that because that was one time. If I would have continued to do it and got into a habit of it, I think that would have been that's just a great habit to get into.
Yes. Yeah. I don't know when we get shy. So you're a kid.
It's
You want to talk to everyone, right? It's like you just don't stop asking, you don't stop talking, you don't like that's what you do. And then there's a point in time where it's like, no, now I'm shy. Now I don't want to ask people something. I guess it's probably to everyone something happens where you ask enough times and then someone says like
I think
no.
our curiosity is satisfied with electronic devices right now. So we're
No,
curious about
yes.
something, we'll go to a feed. Versus before that phone was there and you're waiting online to board your plane, which could be a half an hour, you could turn around and talk to the person behind you probably just to kill the time. And same thing once you actually sit down, everybody instantly opens up their laptop, opens up their phone, starts watching a movie. Before that was available, you've got 6 hours to kill with two strangers. Why
Yes.
not strike up a conversation? And if they don't want to talk, they'll let you know. But at least you've tried.
Yeah. Yeah. I've got a good example of that. When I was in college, well, I was just graduating college. I I went to a supercomputing conference in Hamburg by myself. And it was very interesting, had a lot of fun, etc. On the way back, on the flight from Heathrow, because I then did like a Europe thing to know places. Speaking of like meeting people, amazing.
Hmm.
Just meeting people anywhere because I had nothing else to do but just go around. The person sitting next to me at the time, I had a recording studio. I really liked everything to do with music and audio and all that. For some universal coincidence, the guy next to me is not closing his laptop. You know, the attendant is like, sir, can you close your laptop? Sir, we're gonna, sir.
Hmm.
And so I turn around and I see some formulas and so he closes and I'm like, oh, what? Did you any like acoustics kind of thing? And he's like, oh yeah, I'm the dean of architectural acoustics at RPI, or Rensselaer Polytechnic. And like, excuse me. And so I had like a
That's
6 hour
awesome.
flight talking with the dean, and it was such a fun conversation. And I learned about like really amazing
That
things
is awesome.
acoustically. And then he invited me over that I could, and then I got a tour of the university and all that. Like it, just because you don't shy away from just talking to a
Yeah.
stranger.
Exactly. And people aren't shy about letting you know that they don't want to talk. You can, if as long as you're good at
Yeah.
reading body language and responses. I mean, I'm like that. I mean, I can either be one word answers or like full sentence answers. And if the person, most of the time, the person will get the message that I don't want to, I got something to do. I don't want to talk. But most of the time, hell, I'll talk.
Yeah. 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 If you see someone with AirPods in, leave them alone.
Yeah, yeah,
Right?
exactly.
But if they're like, yeah, that's excellent. So if someone is I don't know, they're doing well, they're maybe 20 million or so, and they've heard it from friends, they've heard it from shows like this one, and they're considering maybe the possibility of an exit sounds interesting. What's the next step for them? What should they do?
That's a great question. And just to tell your listeners and viewers that we did not stage this because this is something that I wanted to share. So that's a great question. So
Glad.
what I've recently launched is something called an exit readiness assessment.
Ooh.
So it's a series of questionnaires. It's very simple to fill out. It's going to take no more than 10 to 15 minutes to fill out. And it's going to give you a value builder score for your business across 8 different categories with and compared it to industry averages. So it'll show you where you stand on 8 different drivers of enterprise value. So we can have a conversation on where the levers are red or yellow and how they can be improved. And if the levers are green, got to make sure that we concentrate on keeping those levers green. So, and in addition to that, I do something called a pre-score personal readiness assessment, where it kind of it's a series of questions. There's not that many. A person's psychological readiness to exit their business. Like, are they emotionally attached, to their company? Does their family work there? Is their personal identity wrapped up into this business, et cetera, et cetera? So there's also like just a number, a score on what your psychological readiness to sell your business is, and then something called a personal freedom score. From a financial perspective, how dependent are you on your company for your current lifestyle that you want? And based on a whole bunch of factors, we can figure out, are you 100% dependent? Which obviously, at least to my earlier point, you've got a lot of risk, in your company right now because it's 100% of not only your assets, but of your cash flow that you need to have your lifestyle. So, these 3 tests give somebody a really good indicator of where they stand. And from there, they have a game plan on what to do to improve. Or they can say, you know what? I got it. It is what it is. Now I know my numbers, and I don't need to do anything. So it's a really nice tool and process to go through. And I'm
I
happy to
like it.
share the information with your listeners.
Yeah, yeah, please give me the link and I'll put it in the show notes. It's I love these little tests and assessment kind of things because they can very quickly give you a lot of information that you would have spent a lot of time trying to figure out. And it's based on data from people who are in it, right? So it's very different. For my case, we build software and AI and things like that. And so for someone to think, oh, I want to build this product that does this and this and this, they might just think, yeah, it could be done, but they don't think of the 11 things that you have to like actually think about. And if they tell me, I'm like, oh, but did you even think about this? And what about this and this other thing and this other thing? And like, oh, and now they can expand their thing. So in your case, like it's so important to get that structured answer based on years of experience in the thing, because you know which questions to ask. So I'm glad that it's like an open thing that people can actually just take. Um, and I really like that you have the three of them. So it's like, how's the company, right? But then how are you psychologically attached to it? Are you ready for it? That's really important. I hadn't really heard that too much. And then also the attachment, like how dependent are
Financially
you
attached. Right.
separate from as an individual? These are great. So are they on the same page, or are they three separate things?
So it's three different assessments, three different questionnaires. The company one will take about 10 minutes to complete. The other two will take about 5 minutes to complete. It doesn't require a ton of information, and it really forces somebody to truly think. And as long as they answer honestly, I can give them not only the results that the assessment produces, but like my interpretation of the
Nice.
results, having been in their shoes and lived through many of these exits.
Amazing. I'll definitely put those in the show notes. And Steven, if someone wants to talk to you or your team about like how all this works, they're interested in like doing a little more, getting a little more in depth, how can they find a little more about
Sure.
how to
I mean,
contact you?
you can find everything about me on my website, and it also has all of my social media handles, and that's stevenpivnik.com. And the best way to contact me is via LinkedIn, and my handle there is also at Steven Pivnik, one word.
Excellent. I'll put those in the show notes as well. Again,
Excellent.
Steven, this has been amazing. A super fun conversation. I learned a lot. I'm sure our listeners learned a lot as well. So thank you so much for sharing all your knowledge with us.
Thank you for having me on the show. I really enjoyed our conversation.
It's been a true pleasure. And for those listening, if you haven't, please like and subscribe to the show so that you can learn whenever we have new episodes coming out, like this amazing one with Steven. And be sure to follow Steven as well so you can get his continued excellent advice on his socials as well. Thanks, everyone. And we'll see you in the next one.